ক্লিক করুন অ্যাপের বেল আইকনে আর সাবস্ক্রাইব করুন এবিপি আনন্দ। সব সময় থাকুন খবরে।
রিজার্ভ ব্যাংকের গভর্নর শক্তিকান্ত দাস সাংবাদিকদের মুখোমুখি সরাসরি চলে যাব।
Activities have, however, provided a beacon of hope on the back of an increase of 3.7% in food grain production to a new record. A ray of hope also comes from the forecast of normal southwest monsoon by the India Meteorological Department. By 10th May 2020, up to which the latest information is available, Kharif sowing was higher by 44% compared to the last year's acreage. Rabi procurement is in full flow in respect of oilseeds, pulses, wheat, benefiting the bumper harvest. These developments will support farm incomes, improve the terms of trade facing the farm sector, and strengthen food security for the country. Going forward, these would also have a salutary effect on food price pressures. The inflation outlook has become complicated by the release of partial information on the Consumer Price Index by National Statistics Organization, obscuring a comprehensive assessment of the price situation. From the incomplete data that have been made available, food inflation, which had eased in January, from its January 2020 peak for next 2 months, that is during February and March. Now suddenly they have reversed and surged to 8.6% in April as supply disruptions took their toll, immune to the ongoing demand compression. Prices of vegetables, pulses, oilseeds, milk and cereals emerged as pressure points. In the external sector, India's merchandise exports and imports suffered their worst slump in the last 30 years as COVID-19 paralyzed world production and demand. India's merchandise exports plunged by 60.3% in April, while imports contracted by 58.6%. India's foreign exchange reserves have, however, increased by 9.2 billion during 2021, that is from 1st April onwards, and so far, that is up to 15th of May, our foreign exchange forex reserves, they stand at 487 billion US dollars, which is equivalent to 1 year's imports. I now go to the outlook with regard to inflation and growth. Against this backdrop, the MPC assessed that inflation outlook is highly uncertain. The supply shock to food prices in April may show persistence over the next few months, depending upon the state of lockdown and the time taken to restore the supply chains after relaxation of the lockdown. Among the pressure points, the elevated level of pulses inflation is worrisome and warrants timely and swift supply-side interventions, including a reappraisal of the import duties. Immediate step-up of open market sales, PDS offtake by FCI to offload some part of excess stocks can also cool down cereal prices and also create room for Rabi procurement. Given the current global demand-supply balance, international crude oil prices, metals, and industrial raw materials are likely to remain soft. This would ease input costs for domestic firms. Deficient demand may hold down pressure on core inflation, although persisting supply dislocations impart uncertainty to their near-term outlook. Much will depend on the shape of the recovery after COVID-19. Accordingly, the MPC is of the view that headline inflation may remain firm in the first half of 2020, but should ease in the second half, aided also by favorable base effects. By Q3 and Q4 of the current financial year, it is expected that the headline inflation will fall below the target of 4%. Thus, the MPC's forward guidance on inflation is directional rather than in terms of levels. Going forward, as and when more data are available, it should be possible to estimate the path of inflation with greater certainty. It is in the growth outlook that MPC judged the risks to be the gravest. The combined impact of demand compression and supply disruption will depress economic activity in the first half of the year. Assuming that economic activity gets restored in a phased manner, especially in the second half of this year, and taking into consideration favorable base effects, it is expected that the combination of fiscal, monetary and administrative measures being currently undertaken both by the government and the RBI would create conditions for a gradual revival in activity in the second half of 2021. Nonetheless, downside risks to this assessment are significant and contingent upon the containment of the pandemic and quick phasing out of social distancing and lockdowns. Given all these uncertainties, GDP growth in 2021 is estimated to remain in the negative territory, with some pickup in growth impulses in H2 2021 onwards. The end May 2020 release of NSO on national income should provide greater clarity, enabling more specific projections of GDP growth in terms of both magnitude and direction. Much will depend on how quickly the COVID curve flattens and begins to moderate. As the nation prepares for this future, the words of Mahatma Gandhi should inspire us to fight on. I quote, "We may stumble and fall, but shall rise again," unquote. The MPC is of the view that the macroeconomic impact of the pandemic is turning out to be more severe than initially anticipated. Beyond the destruction of economic and financial activity, livelihood and health are severely affected. Judging that the risks to growth are acute, while the risks to inflation are likely to be short-lived, the MPC believes that it is essential now to instill confidence and ease financial conditions further. This will facilitate flow of funds at affordable rates and rekindle investment impulses. It is in this context that the MPC voted to reduce the policy repo rate by 40 basis points from 4.4 to 4%. If the inflation trajectory evolves as expected, more space will open up to address the risks to growth. Now, I now turn to some regulatory and development policy announcements. The regulatory and developmental measures which we announced today, they are being done to complement and amplify the reduction in the policy repo rate decided by the MPC. As I have said earlier, the RBI has been constantly monitoring the situation. We are extremely careful and very, at the level of vigilance is at its highest, is at its peak in RBI. Our entire team of officers are closely monitoring the developments in various segments of the economy, and you would have seen that over the past 2 or 3 months, as and when it was warranted, the RBI has not waited for a formal statement to be made by the governor, but we have been taking policy measures. And as and when the situation warrants, to the best of our ability, we are reacting to situations, we are trying to anticipate and also trying to be proactive, and that shall continue to be under the underlying theme of our approach. In my statement at the time of MPC meeting in February 2020, I had pointed out the increasing downside risks to global growth in the context of the outbreak of coronavirus, the full effects of which were still uncertain and unfolding at that time. That is in the first week of February. Since then, RBI has proactively managed liquidity conditions, expanding its array of measures, both conventional and unconventional. In the meantime, the monetary policy transmission to banks' lending rates has also continued to improve significantly. I have some details about the transmission of policy rates in the various segments of the financial markets. I have also data about the transmission of the policy rate to the new fresh loans being sanctioned by the banks. I am not reading them out. They are contained in my statement. Those who are interested may please have a look at the statement, which will be uploaded immediately after this statement on the television and in the YouTube is over. The decision of the MPC to reduce the policy repo rate and maintain the accommodative stance of monetary policy provides the opportunity for the RBI to announce certain additional measures against the backdrop of a deteriorating outlook for economic activity. These policy actions complement and strengthen each other in intent and reach. The measures being announced today can broadly be delineated under 4 categories. 1. Measures to improve the functioning of markets and market participants. 2. Measures to support exports and imports. 3. Efforts to further ease financial stress caused by COVID-19 disruptions by providing relief on debt servicing and improving access to working capital. And 4. Steps to ease financial constraints faced by the state governments. I first take up measures to improve the functioning of markets. The RBI had earlier announced a special refinance facility of 15,000 crore to SIDBI at RBI's policy repo rate for a period of 90 days for the lending and refinancing operations of the SIDBI. In order to provide greater flexibility to SIDBI, it has been decided to roll over the facility at the end of the 90th day for another 90 days. The next point relates to investments by the foreign portfolio investors, that is FPIs, under the voluntary retention route of the RBI. Since its introduction, the voluntary retention route scheme has evinced strong investor participation, with investments exceeding 90% of the limits allotted under the scheme. In view of the difficulties expressed by FPIs and their custodians on account of COVID-19 related disruptions in adhering to the condition that at least 75% of allotted limits be invested within 3 months, it has been decided that an additional 3 months' time will be allowed to FPIs to fulfill this requirement. The next set of measures relate to our effort to support exports and imports. The deepening of the contraction in global activity and trade, accentuated by rapid spread of COVID-19, has crippled external demand. In turn, this has impacted India's exports and imports, both of which have contracted sharply in the recent months.